Good morning. It's time for another edition of PreMarket PulseScan with yours truly, Dex, the Algo Capitalist, aka the Vulcan, coming to you live from PulseWaveTrading.com, home of the world famous PulseWave price trigger reports that we put right in your hands each and every trading day. So you wake up to a new world today. It's Thursday. Yesterday was hump day, and guess what? This is pretty much the last day for the market to decide what it wants to do before Take Back Friday. All right, so basically, we had our unemployment filing total report just moments ago, and we're standing at 36.5 million unemployed persons. 36.5 million job losses, 36.5 million jobs that are not coming back. That's 36,500,000 jobs that have been lost because of closing down the country. They literally stopped the economy. Now, remember back in the day, those of you who were with me back on the Wide Awake News show with the late, great Charlie McGrath, you recall we had such conversation. We're talking about, what kind of desperate measures, what kind of severe measures would it take to get the government's attention? And we talked about, starving the beast. Like, what would the world look like if everyone just for one day said we're not going to spend a dime, not credit cards, not cash, no nothing, like bring the economy to a halt. It never manifested for whatever reason until now. Now that's pretty much what you've seen. You've seen everyone basically go on strike per se because no one went to work. And the result of that is 36 million job losses. This is the equivalent of what would have happened if everyone decided, you know what, we're just not going to spend money for a little bit. And realistically, if we were able to go a couple of months without spending a dime, this would have been the result. Not just, punishing the banks, but we would have crashed the economy. Very interesting to see the what if scenario that we talked about back then come to fruition today. Just something to think about. I mean, I thought it was a very interesting gift that we've been given to see what the world would have looked like if everyone decided to do that. If everyone just decided to stop spending. This is what it looks like. Business will go out of business overnight, just like we see in here. And even still, the market is not reflecting the real truth. And their numbers are still being edited and massaged. We're still not getting the real scope and breadth of the situation. I believe the situation is much, much, much more dire than what we have been led on to believe. So with that being said, I don't know where we go from here, fam. It's not looking too hot. It ain't looking too pretty. With all this news, the dollar is back above par and it's up 20 pips. Go figure. Who would have thunk it? Who knew that on the back of crummy news, the US dollar will catch a bid? Very interesting this morning. Futures went down because they didn't like that information when it came out. The futures market winced. It just didn't like it, wasn't feeling it. And it made the market drop. And it took out the overnight lows that quick. As soon as this thing came out, the market just said, I'm not having it. I can't deal with this. This is too much. And it just sold off. It was just a really surreal thing to watch. Just when it looked like the market was going to get a little technical bounce going on today. But nope, no continuation pattern today. Instead, we're looking at something totally different. And while we're at it, let's jump right into these overnight markets, shall we? Okay, so Dow futures are down 272 points at 22,896. That's right. We're back into the 22,000 handle. NASDAQ 100 is down 63 points at 89.29 and a quarter. Even the S&P 500 is down 23 3/4 at 27.89 and a quarter. Russell is off 29.8 points at 1,200 even, 0.1. Bitcoin futures composite index is actually strengthened on the back of this. Currently trading at $9,710, up $440. Overnight high for the Bitcoin futures composite index, 10,070. That's right, 10,070 for the Bitcoin futures composite index. We did hit an overnight low, though, of 9,355. What a rally off the lows. That's what I'm talking about. That's that power right there. Looking at that gas up a penny, $1.63. Crude oil hanging on to that $25 handle. It's up 65 cents at $25.90 a barrel. It did hit an overnight high of $26.72 a barrel. Looking at the long bond, it's up a full point in 1/32, trading back above that 180. It's at 181 and 22/32. So it's jumped right back to the 180s. We were starting to go lower, like the 178, 177 handle. So it is really powered up. Gold is up now $7.90, trading at $1,724.50 an ounce. So it is maintaining that 1,700. Looking at silver, silver is up a penny at $15.69 an ounce. Overnight high was $15.84 an ounce. So it's just holding on, but it is near the low of the narrow range session. 1566 is the overnight low. All right, looking at your US dollar index, we're above par, up 17 pips now at par 0.41. The euro is off 22 pips at 108 even. The pound sterling is off 27 pips at 121.94. The Aussie is down 18 pips at 64.22. Canadian dollar is up about 5. It's at 141.04. Euro yen is off 32 pips at 115.48. And the dollar yen is off 5 pips at 107 even. The Kiwi New Zealand dollar is down 22 pips at 5.971. Going over the food, your beans are off 2 1/4 points at 8.37 1/4. Your corn is up 1/4 of a point at 3.18 1/2, and wheat is down 3 3/4 points at 4.98 even. Something that I was hearing on the coming across the wires this morning as I was watching the business news report, and I have to say, it looked like we were talking about some new bills and some new passages, things like that. And it's very interesting that they actually labeled this bill 666, and that's supposed to be the surveillance thing that they want to bring about. It's really, really, really dastardly when you think about it. I mean, they're using this whole lockdown thing to really get some things done. And I must say, it is really not too much of a surprise. They're not going to let a pandemic go to waste, you know? So global stocks are dropping after Fed Chair Jerome Powell struck a dovish tone during a speech on yesterday, which was Wednesday. Powell cautioned the coronavirus pandemic could cause long-term damage to the U.S. economy, warning that the path ahead is both highly uncertain and subject to significant downside risks. European stocks were down more than 2% while U.S. futures pointed to a negative open for all three major indexes. A London-based trading house bought 250,000 barrels of oil during the historic plunge below zero and likely made a fortune. One trader bought 250,000 barrels of oil and secured a rare payout at a time when oil prices turned negative, causing jitters in markets and leaving most other traders scrambling to find storage options across both sides of the Atlantic, Bloomberg reported on Wednesday. I cannot believe that people are writing fake articles and passing it off as reality. This doesn't make any sense whatsoever. Who is lying and why? Why are they lying about the oil market? They're keeping this lie going. First of all, you said trader. You didn't say producer. You didn't say hedge. You didn't say none of that. You didn't say, I can say they said Exxon did this, or if Chevron did something, or something like that, or some other producer or manufacturer. They say trader. A trader is not one who takes delivery on anything. Traders never take delivery of physical commodities. How many times must we go over this? Why are you lying? Leaving other traders scrambling for storage space. First of all, you don't even have the wherewithal to receive such said commodity. You have to open up a hedging account showing that you are a hedger / producer, user of the commodity product, and that you plan to take delivery on all of your transactions. All right, that's what that's about. Don't forget, there are laws in every country that when it comes to the manufacturing and holding and maintaining of commodities. And we're talking about the political nuclear warhead of oil. Do you understand that you don't just open up a trading account and say, I'm going to trade crude oil so I can take delivery of it? You ain't got no storage tanks. All right. Plus, that is something that is controlled and regulated and managed and watched over like a hawk by the governments of the world. You think you're going to take delivery of a few 100,000 barrels of oil and the government don't come knocking, figuring out who are you and what are you doing with that? How are you carrying it? Do you know you got to have an oil farm, some type of oil farm when you're storing this stuff at, and it has to meet government standards. They got to bring all types of dudes in suits and hard hats over to there to approve this, approve that. Do you know what kind of hurdles and stuff you got to jump through just to even maintain something like that? Even if you're not going to build an oil farm yourself and you just want to take delivery and you're going to pay someone else to hold it for you, once again, contracts have to be entered to. There's all types of rules, regulations, and just not anybody can go do that. That's analogous to me going on the dark web and ordering some uranium and some plutonium and all these other things. Ordering a few slaves, ordering laser cannons, and all this other stuff. And you think that the feds aren't going to come knocking on my door? Is that what you think? And they're not going to knock. They're going to break the door down. They're going to be Black Hawk helicopters over my house and everything else. Are you kidding? And you want us to believe that some trader in London was able to just buy himself 250,000 barrels of oil just like that, and was able, all I have to do is just scramble and find storage place. Any facility will let me just store my oil there. I thought that you guys were reporting that there is nowhere to place the oil, that all resources all over the world are just maxed out. We have a glut of oil and we have nowhere to put the oil. So how is it so easily, people that scrambling to find it? Please stop it. Not anybody is just allowed to trade in oil. Did you know that? You don't just get to trade whatever you want and take physical delivery and say, I'm in the market now. There are licensings. There's other rules and regs. Stop lying in these news pieces. He may have traded 200,000 barrels worth of a futures contract. Let's break that down. That means that he was trading several hundred futures contracts. One futures contract, unless they changed it in recent years to my unbeknownst, well, then guess what? It's 5,000 barrels of oil. One crude oil futures contract, not the big contract, is equivalent to 5,000 barrels of oil. 5,000 barrels of oil. So he's trading a few dozen, couple hundred contracts to get up to that 200,000 mark. Okay, fine. But like I said, unless you have done it before you opened your account, while you're in the process of opening your account, you did that. You're not even allowed to take delivery. No one's going to take you seriously. They're going to just X you out of your positions when the contract expires and pay you in cash. You will settle in cash. You're not taking delivery of nothing. Oh, no, I want to take delivery. No, you can't. It doesn't work like that. There's rules, regulations, and processes. Stop lying in these business articles. Good grief. All right, Alexandra Ocasio-Cortez, whatever, poke-funded Bill Gates' plan to boost billionaires' coronavirus donations, suggesting they pay their taxes. Representative, whatever her name is, whatever, Cortez poke-funded Bill Gates' plans to push his fellow billionaires to donate more towards fighting coronavirus, arguing they could just pay their taxes in a tweet on Wednesday evening. Of course, using the opportunity to get her name back out there, even if it's in the negative light. Even negative press is good press. All right, so let's see here. Amazon will drop its $2 pay raise for warehouse staff after May, and workers say it's too soon. Amazon will, at the end of May, scrap the $2 hourly raise it introduced for warehouse workers coming in during the coronavirus pandemic. Isn't that nice? Isn't that nice? Yeah, Joel, you're so right about that. Joel in the live chat says the news can't even answer the simple questions of who, what, when, where, and why, and how. The real news people of yesteryear are rolling in their grave. You're right. This is not news anymore. It's propaganda. Talking about fake news. Give me a break. Good grief. We're inundated with it. All right, let's see here. Let's see. Thy secret and Germany's biggest union call for further consolidation in warship sector. All right. Germany's largest union, IG Metall, on Thursday called for further consolidation of the country's warship sector, saying a tie-up of rivals Lorison and German naval yards did not go far enough. I don't even know why that's news, and what are you talking about? Fiat Chrysler deal in spotlight after Exor setbacks. Fiat Chrysler's decision to scrap its dividend marks another setback for plans by the Angeli family Exor arm to raise cash after a $9 billion sale of its Reassure unit partner Ray collapsed this week. Uber offer for Grubhub fans worries over delivery fees charged to restaurants. The possibility that Uber, which runs Uber Eats, could acquire Grubhub is reigniting some restaurants' worries over the commissions charged to eateries by the third-party delivery companies. The coronavirus crisis is a window of opportunity for bankers to the rich. When markets slumped in March as the spread of coronavirus gathered pace, wealth managers' trading volumes soared as ultra-rich clients reshuffled their portfolios. First quarter earnings coming in. Prudential and Petrobras are coming in. Economic data releases today. The biggest thing to watch is the initial jobless claims, which I already told you about, while the EIA will also announce its national gas storage change figures. Quite a mouthful there today, folks. I must say, out of all the news we've done so far this week, as far as the overnight market news, that had to be the most boringness one. I was listening to my own voice, and all I heard was wah, 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 wah. All right, let's see what else we got. Let's see. Give me just give me a second here. Let's see. All right. Oh, this is interesting. All right. That may no. Hold on, let me see. Okay. I don't know about that one. Looking for some real good stuff here, and I'm just not finding it. Okay, here's something that is interesting. I think we'll do this one. All right, let's see. All right, here's another one. Nope, that's not good enough. I like the good stuff, the juicy stuff. Let's see. Nope, that's not a good one. Nope. No. That's not a good one. Oh, this is definitely a good one. Okay. All right, I think I got us covered now. I think I got us covered. Let's see. We're gonna go with the very first one right quick. Get this out. All right. Are y'all ready? Y'all ready to dive off the deep end? Because we about to do that. We about to go in. All right. 992 billion reasons why the Fed needs another market crash in the next few weeks. Interesting. Speaking in a video conference organized by the Peterson Institute, turbo money printer Jerome Powell, oh, there's your opening bell for those so inclined, today reassured the market that negative rates are not something the Fed, which expanded its balance sheet by 2.6 trillion in the past 2 months, is contemplating now. Of course, that will change after the next market crash or if the economic shutdown returns. But for now, the Fed's message to traders was clear. Don't push forward Fed funds rates negative, which also catalyzed today's sharp market drop as a key source of potential forced easing was removed. However, with Powell talking negative rates off the table for now, it means the Fed has another problem on its hands. One which was first laid out by the Deutsche Bank's credit strategist, Stuart Sparks, who in a recent note said that for all the measures taken by the Fed and fiscal authorities to counter the COVID-19 shock, policy remains too tight. And as Sparks adds, if the Fed opts to avoid negative policy rates, which appears to be the case, further easing must be provided by the size and composition of the Fed's balance sheet, meaning more QE. Who would have guessed? How much more QE? Well, with short-dated market real yields positive, Deutsche Bank estimates that the neutral rate of interest has fallen around negative 1%, suggesting additional accommodation required for policy to be easy. Could be more than 100 BP in terms of policy rate equivalent. Previously, the Fed had estimated that $100 billion in QE has approximately the same short-term impact of growth as 3 basis points of rate cuts. This equivalence means that in order to provide a 1% of rate equivalent easing, the Fed would need to grow the balance sheet by roughly 3.3 trillion. This creates a headache for the Fed, and the balance sheet growth of this magnitude creates a structural supply-demand imbalance, even given extraordinary Treasury funding needs, and should compress the term premium over time. And given Deutsche Bank's projections for Treasury supply and Fed purchases, this imbalance could be as large as $1.4 trillion. Ultimately, the argument is that the drain of duration supply dominates maturity selection implicit in Fed purchases, causing the term premium to decline. Even more, term premium distortions aside, the Fed has no choice, as we explain below. But as crazy as it may sound, despite the Fed's massive liquidity injection to date, which has pushed the Fed's balance sheet from 4.2 trillion to 6.7 trillion since mid-March, it is not enough. And to ensure that the problem of the negative 1% is addressed without cutting rates negative, a problem which is now manifesting itself in a chronologically high dollar, i.e. dollar shortage, which has failed to normalize back to pre-crisis levels, the Fed will need to expand its sheet, trillions, and it will have to do it very soon. As curvature securities strategist Scott Skyrim, I can't believe his name is Scott Skyrim? Wow. Writes today, general collateral unexpectedly dropped down to 0% yesterday and was below 0% today. And while this is a strange, Skyrim correctly points out that low GC rates can only be temporary. The reason? There is a flood of liquidity draining issuance on the horizon. I can't do it. As Skyrim Elder Scrolls further explains, with QE purchases winding down, recall that last Friday the Fed cut its daily POMO average to just $7 billion from $75 billion 2 months ago. The deluge of more Treasury supply will ultimately push rates higher. The deluge of more Treasury supply will ultimately push rates higher. Got to underline that one. But in the near term, things are about to get scary. As Skyrim Elder Scrolls calculates, there are $79 billion in CMBs settling tomorrow and 39 net new Treasury settlings on Friday for the refunding. But that's just the start. All total, there are 689 billion net new treasuries settling during the month of May and 992 billion net new treasuries settling between now and June 15th. Yes, almost 1 trillion new treasury securities hitting the market within the next month. Dun, dun, dun. His conclusion, talking about Skyrim Elder Scrolls for PS4. That means the market needs to come up with about $1 trillion to pay those securities over the next month, which of course is a euphemism because we all know who in the market needs to come up with $1 trillion. The only one who literally prints money, the Federal Reserve. For those who missed all that, here is the layman's version. The Fed has flooded the system with liquidity, and it is not enough. All right, now let's insert this here. The Fed has flooded the system with liquidity over the past 20 years non-stop. Because the way helicopter money works is that liquidity supply, the Fed, and liquidity demand, the Treasury, via debt issuance, go hand in hand. And periods of too much supply, as was the cash with the Fed's massive QE in late March and early April, are promptly followed by periods of dramatic liquidity demand, such as the next month when $1 trillion in liquidity will be drained to fund the U.S. government money helicopter. This also suggests that Deutsche Bank's estimate of $3.3 trillion cumulative shortfall is accurate and that the Fed will soon find itself trapped again because instead of injecting liquidity, it continues to drain it by shrinking the weekly POMO injection. In other words, if the patient can't get its weekly POMO injection, it is going to keel over. This also suggests that Deutsche Bank's estimate of 3.3 trillion cumulative shortfall is accurate and that the Fed will soon find itself trapped again. It will find itself in an R. Kelly remake of Trapped in the Closet again. Because instead of injecting liquidity, it continues to drain it by shrinking the weekly POMO injection. As a result, Powell faces a twofold problem. Since the Fed chair has taken negative rates off the table, Powell has no choice but to boost QE again and unleash another fire hose of liquidity in the financial system. However, any such reversal to the Fed's current posture of shrinking QE will be met with howls of rage. Howls of rage. Makes you think you're playing Doom, or maybe you're playing Elder Scrolls Skyrim, or maybe you're playing Dragon's Dogma and the Dragon is angry and he's raging as he is pouncing on you from high above the clouds, especially in the political establishment, which means that just like in March when the Fed used the first pandemic-induced market crash to unleash unlimited QE, the Fed will soon have to go for round two and spark a new market crash, one which then uses an alibi for the next massive liquidity injection. Failing to do that, watch as the dollar takes off as markets sniff out that another major dollar squeeze is imminent. And since this will accelerate the liquidity crunch, one way or another, the coming $992 billion net treasury issuance will serve as a trigger for the next market shock, one which the Fed will quickly reverse by expanding the already unlimited QE by over $3 trillion on the very short notice. The only question we have is whether this will be the market crash that the Fed uses to unveil it will also buy equity ETFs next, or if Powell will save this final bullet and its ammo for whatever comes next. Good, googly, gobbly goops. The Fed is in a pickle. Quite the pickle. Oh yes, quite the pickle. They don't have a choice. They have to keep doing the QE. If they don't, then the stock market will implode upon itself. They don't want that. Look, man, you can only get so much morphine injected into your veins. All right? I don't understand what the problem is. But just in case you thought you were safe because you somehow got yourself a copy of The Art of the Deal by President Donald Trump, now you think you are Donald Trump. You think that you are a real estate maven. You are a real estate maverick. You are a real estate mogul. You think you are Mr. Big Draws up in the place. You really think that? You think you stomping with the big dogs? Is that what you think? Well, this next one is for you. The Big Short Part 2 hits an all-time low as commercial real estate implodes. Commercial real estate implodes. Keep in mind, ticker IYR as we go forward. Back in March 2017, a bearish trade emerged, which quickly gained popularity on Wall Street and promptly received the moniker the next Big Short. As we reported at the time, similar to the run-up to the housing debacle, a small number of bearish funds were positioning to profit from a retail apocalypse that could spur a wave of defaults. Their target, securities backed not by the subprime mortgages, but by loans taken out by beleaguered mall and shopping center operators, which had fallen victim to the Amazon juggernaut. And as bad news piled up for anchor chains like Macy's and JCPenney's, Bearish bets against commercial mortgage-backed securities kept rising. The trade was simple: shorting malls by going long default risk via the CMBX6, triple B minus or BB, or otherwise shorting the CMBS complex. For those who have not read our previous reports, and it gives some links here, and here on the second big short. Here's a brief rundown via the journal. Each side of the trade is speculating on the direction of an index called the CMBX6, which tracks the value of 25 commercial mortgage-backed securities, or CMBS. The index has grabbed investor attention because it has significant exposure to loans made in 2012 to malls that lately have been running into difficulties. Bulls profit when the index rises and shorts make money when it falls. The various CMBX series are shown in the chart below, with the notorious CMB6 most notable for its substantial 40% exposure to retail properties. For the average layman, the IYR ticker is for you if you don't believe the hype about the prosperity of these things. One of the firms that had put on the Big Short 2 trade block in late 2016 was hedge fund Alder Hill Management, an outfit started by protege of hedge fund billionaire David Tepper, which ramped up wagers against the mall bonds. Alder Hill joined other traders, which in early 2017 bought a net $985 million contracts that targeted the two riskiest types of CMBS. These malls are dying, and we see very limited prospect of a turnaround in performance, said a January 2017 report from Alder Hill, which began shorting the securities. We expect 2017 to be a tipping point. For those of you that remember back in the day, there were people, especially in Florida, driving around showing you all the ghost towns. There were entire suburban communities that were standing empty. There were brand new medical complexes. I even saw some in my area that were empty. They had no tenants. Buildings are finished, complete, but they were sitting empty. And this wasn't in no poor area. This wasn't in no lower middle class area. Nah, this was in a rich, wealthier area. All right, where you couldn't drive your car down the street without seeing some sort of Lamborghini, Ferrari, or Rolls Royce. And that's real talk. I'm not even kidding. I'm not even being funny. I saw Lamborghinis, Rolls Royces, and Ferraris on a daily. But yet this medical complex that they built was mad empty. And it stayed that way for a long time. Even when I left and moved away from the area, it was still empty. And that was a very long time ago. So this has been something that has been imploding for a minute. In my estimation, the commercial market really never bounced back. And technically speaking, the real estate market really never bounced back either, as far as residential real estate. All right, so not only was 2017 not a tipping point, but the trade failed to generate the kinds of desired mass defaults that the shorters were betting on. While the negative carry associated with the short hurt many of those who were hoping for quick riches, one of them was investing legend Carl Icahn, who, as we reported last November, emerged as one of the big fans of the Big Short 2. Although, as even he found out, CMBX was a very painful short, as it was not reflecting fundamentals, but merely the overall euphoria sweeping the market and record Fed bubble, very much like most other shorts in the past decade. The resulting loss, as reported last November, was tens, if not hundreds of millions in losses so far for the storied corporate raider. That's right, you guys. See, the truth is coming out. The people that you looked up to and thought was all this and that, they're losing a fortune. All right, and it's mostly kept out of the media. But this is showing you even your boy Carl Icahn got his face completely and utterly ripped off. You want to know why? because they're trading it in illiquid securities. This is not something that you can just go in and type this in CMBX and you'll get a quote on your Thinkorswim platform. This ain't that. Okay. Now if they were, let's say they were, buying the ETF or something, that's a different story. But as you and I both know, that's not how they get down. They don't do that. All right. They don't. All right. So they trade these illiquid things that are not available to retail people. It's just what they do. It's how they get down. It's how they're built. All right. While you and I, we have to, deal with what the brokers say that we're allowed to trade and get down in. That said, while Carl Icahn was far from shutting down his family office because one particular trade has gone against him, this trade put him on a collision course with two of the largest money managers, including Putnam Investments and Alliance Bernstein. Well, I haven't heard Putnam's name mentioned in years. Putnam used to be the man as far as mutual funds. Janus Mutual Funds and Putnam, which for the past few years had a bullish view on malls and had taken the other side of the Big Short CMBX trade. The Wall Street Journal reports. This face-off, in the words of Dan McNamara, a principal at the New York-based MP Securitized Credit Partners, was the biggest battle in the mortgage bond market today, adding that the showdown is the talk of this corner of the bond market, where more than $10 billion of potential profits are at stake on an obscure index. However, as they say, good things come to those who wait and are willing to shoulder big losses as they wait for a massive payoff. And for the likes of Carl Icahn, McNamara, and others who were short the CMBX, payday arrived in mid-March just as the market collapsed, hammering the CMBX series triple B minus. And while the broader market has rebounded since then by a whopping 30%, the trade, also known as the Big Short 2, has continued to collapse. And today, CMBX 6 hit a new lifetime low of just $62.83, down $10 since our last update on this storied trade several weeks ago. That, in the parlance of our times, is what traders call a jackpot. Why the continued selling? Because it is no longer just retail outlets and malls. As a result of the COVID lockdown and America's transition to work from home and stay away from all crowded places, the entire commercial real estate sector is on the verge of collapse. As we reported last week, and a quarter of all outstanding CMBS debt is on the verge of default. Sure enough, according to a Bloomberg update, a record 167 CMBS 2.0 loans turned newly delinquent in May, even though only 25% of loans have reported remits so far. Morgan Stanley analysts said in a research note Wednesday, tripled the April total when 68 loans became delinquent. This suggests delinquencies may rise to 5% in May, and those that are late but still within grace period track at 10% for the second month. All right, let's stop right here. For those who are not in the know, for those that never worked in finance, never worked in banking, never worked in a mortgage loan origination office, for those who never traded securities or advised those who do, those who did not hold securities license, whether it be a Series 7, Series 3, 65, 66, whatever. It is a known fact that realtors and the agency which represents realtors hold back the numbers. All right, they do that periodically. All right, because they don't want things to look as bad as they really are. So they're slow and forthcoming with the numbers. They do other tricks too, like leave certain things off the MLS. So really, technically, there may be 1 billion houses for sale in your area, but they'll show only 1,000 sales because they'll leave a lot of stuff off the MLS. You probably didn't know that, but that's why I'm telling you that. For those that don't know what the MLS is, that's the platform that realtors use when they're posting houses for sale, for rent, and all that other good stuff. All right, that's a realtor's thing. You got to be a realtor to even access it. And you got to pay your monthly dues on that joint too if you want to have access to it, if you are a realtor, a licensed realtor. So anyway, for them to give the numbers that they're giving right now, they're not going to really report the true numbers. Even if they're experiencing a lot of pain, they'll do what they got to do to massage those numbers. Even when the mortgage crisis was at its peak, they were throwing a lot of sunshine on it and say, "Oh, well, right now this is happening. This is really good. Well, it didn't matter how bad the situation was. They threw sunshine on it to make sure that when it was reported in the mainstream media that they put a sunny spin on it." Okay, so you really can't trust that industry either. Just letting you know. Looking at the carnage in the latest remittance data and explaining the sharp leg lower in the Big Short 2 index, Morgan Stanley said that several troubled malls that are a part of CMBX6 are among the loans that were newly delinquent or transferred to special servicers. All right, among these were Crystal Mall in Waterford, Connecticut, is currently due for the April and May 2020 payments. There has been a marked decline in both occupancy and revenue. This loan accounts for nearly 10% of a CMBS deal called the UBSBB 2012 C2. All right, Louis Gillette Mall in Gillette, Illinois is also referenced in CMBX6. The mall was originally anchored by Sears, JCPenney, Carson's, and Macy's. The loan is also a part of the CMBS deal, UBS BB 2012-C2. A loan for the Poughkeepsie Galleria in upstate New York was recently transferred to special servicing for imminent monetary default at the borrower's request. The loan has exposure in two 2012 CMBS deals that are referenced by CMBX6. Other troubled mall chain tenants include GNC, Claire's, Body Works, and Foot Locker, according to Datix Property Solutions. These all have significant exposure in CMBX6. Now, this right here is the proof that I was telling you about earlier. Remember when I told you, I said the truth about the real estate game, especially the mortgage game, is that it's the A paper people that are in court the most, not the bad credit people, because bad credit people can't rent nothing. All right, understand that. If you have bad credit, no one's going to let you rent an apartment. If you got bad credit, they're not going to give you that business loan. If you got bad credit, you're not going to be able to lease that space in the mall that you want. If you got bad credit, you're not going to get a loan to construct the mall that you want to build. You can't do nothing with bad credit. So who is this affecting? Who is in the CMBX6? Major corporations. All right, even some that were considered Fortune 500 companies. A credit, triple A rating, AA, triple A, double A, super duper dookie, A plus paper is now in default. I don't want to hear, well, the coronavirus. No, save that. Don't want to hear your excuses. Isn't that what you say? Isn't that what you say to poor people before you bang their credit up? Isn't that what you say to them? I don't care that you lost your job. I don't care that you was in an automobile accident and you was on life support for 6 months. Knuckle, where my money at? That's how you treat the poor people. You don't want to hear it. I had an emergency that came up and this and that. I don't want to hear it. I'm evicting you. They always want to make it seem like it's the poor man that is crippling these segments of the economy when it's the other way around. It is the rich man that is in trouble. It is the dude with the incredible credit that is in trouble because poor people can't get credit. All right? I'm just saying, open your eyes, people. Open open your eyes. They always want to blame the poor. They always want to blame the disenfranchised for everything. You can't blame them now for your defaulting on your AAA paper mortgage loan. Yes, they are. You said it, Thunderbird. Corporate welfare queens. There you go. But see, they never want to talk about that. They want to talk about the poor. They always want to beat up on the working poor, but they don't want to talk about those elite individuals with 850 FICO scores. They don't want to talk about them because they're the ones that are hurting the system. Don't blame it on coronavirus. Like you tell poor people, the working poor who are out there struggling, who just one more crisis will put them in the homeless situation. You have no mercy for them. What do you say? What do you come up with the poor when the working poor, struggling? What do you say to them when they have stories to tell you? You tell them, oh, you just don't have no work ethic. Oh, you're just dumb. You're just stupid. No one told you not to go to college. But I did go to college. I actually have a PhD. Shut up. Get back to work. That's how you treat them. You treat the poor. You lump them into one big oatmeal lump, and you say, "This is what y'all are." But when the rich are struggling, when the well-off are struggling, you wanna keep that out of the media. You wanna turn that around and say, nah, it's that subprime mortgage people. It's them working poor people. Nope, it is not. Notice how this article is not talking about Section 8. It is talking about CMBX6, commercial class folks. All right, it's talking about the good credit folks, the people with a $30 million line of credit at the bank, so that they can meet payroll every month. That's what they're talking about. You guys probably didn't know that most major corporations have major lines of credit. All right, they can literally have no money in the bank and still meet payroll because of that line of credit. All right, that's just how it is. See what I'm telling you guys? This right here is proof of what I was telling you. It's the paper people. The people you see in landlord-tenant court are the same ones that have the good credit and was able to even get it to be put in the position to be taken to landlord-tenant court in the first place. It's full of A paper. All right, if you look in the parking lot of the courthouse for people who have to appear in court in landlord-tenant court, there's people driving BMWs and Mercedes. People showing up with high-powered attorneys, lawyers. All right. That is who is in landlord-tenant court. That is the majority of the people in landlord-tenant court. Just FYI, it's people that got the good credit where they can go and purchase things. So I hope this is opening some eyes to what I was telling you. I told you the real estate market is in trouble. I warned you about that. I also told you, I said, I have a funny feeling something is not right. I think the bond market is in a lot of trouble, a lot of trouble. I told you, I said, I think bonds are in trouble. I said, I think real estate market is in trouble. All right. I told you that. So that's why we do what we do here at PulseWave Trading, man. If I can get you guys profitable in these markets, we can at least put a dent in their plans. They can't do what they want to do if so-called poor underclass people are starting to come up. All right. If you come up, there's nothing they can do about that. See what I'm saying? I'm just saying. We are in perilous times, folks. Okay. Just saying. All right. Here is something interesting. All right. This is very interesting. A little different than what we normally deal with, but I like dealing with interesting things. All right. So here's something to think about. Don't think it won't happen just because it hasn't happened yet. We can summarize all that will unfold in the next few years in one line. The way of the towel or the Tao, however you say that, is reversal. This is the opening line of chapter 40 of Lao Tzu's 5,000 character commentary on the Tao Te Ching. There are many translations of this slim volume, and for a variety of reasons, I favor the 1975 translation by my old professor at the University of Hawaii, Chang Chung Yuan, 1907-1988, whom I would occasionally see doing Tai Chi late at night on his front yard in Manoa Valley. Professor Chang, who would often write Chinese characters on the blackboard with great energy to make a point, rendered this line in English as reverse in the movement of Tao. Others have translated it as reversal is the movement of Tao. All right. Given the obscurity and ambiguity of the Taoist concepts, this line has many interpretations. I prefer the way of the Tao is reversal because the Tao is fundamentally about virtue, power, and what we might call authenticity. Thus, all that is presented as permanent will be revealed as impermanent, and all that is presented as true will be revealed as false, and all that is presented as virtuous will be revealed as fraud. In the present era, we can discern these potential reversals. The all-powerful Federal Reserve will lose control and its power will dissipate into thin air. That's number one. Number two, rather than linger at zero or negative rates as expected, interest rates will reverse and start moving inexorably higher. Number three, what was presented as permanent, the value of national currencies and assets, will be revealed as impermanent. Number four, what was presented as the power to force compliance will be revealed as powerlessness. Number five, what was presented as wealth will be revealed as impoverishment. Number six, what was presented as virtue will be revealed as greed and self-interest. Number seven, what was presented as growth was nothing but fraud piled on fraud. And last, number eight, what was presented as permanently abundant, food, credit, etc., will become increasingly scarce. The last one is extremely scary. If we seek a forecast of the era that's now unfolding, consider chapter 9 of the Tao Te Ching as translated by Professor Chang. To hold things and to be proud of them is not as good as not to have them. Because if one insists on an extreme, that extreme will not dwell long. When a room is full of precious things, one will never be able to preserve them. When one is wealthy, high ranking, and proud of himself, he invites misfortune. Or, as Jackson Brown put it, don't think it won't happen just because it hasn't happened yet. I think that's pretty deep. I will go ahead and post this link for you guys in the live chat. If you are listening, my man William, I would like to hear your insights on that one. All right, let's see here. Yeah, I thought that was a dope one. That's why I had to go there on this one. I thought that was very interesting. Some different insights, and there are some comparisons to that, because there is a another thing when it comes to trading, when we talk about how prices like to revert to the mean. So these are all very important things to always look at and watch and consider. Okay. So yeah, man, we going in. We're going in deep. We're going in real deep, getting to the deep end of things. Put your big boy pants on. All right. The creator of the Bond Volatility Index reveals when the Fed will finally lose control. In his latest ad hoc investing note, Where is the Folder?, the legendary creator of the Move Bond Volatility Index and the iconic Merrill Lynch Rate Lab, Harley Bassman, opines in the coronavirus pandemic and wonders how the United States could have been so unprepared for its arrival. We manage the global financial system, which transacts in the currency we print. We control the oceans to ensure the safety of the global supply chain. Our legal system is an aspiration, and our military keeps hotspots localized to mitigate nuclear annihilation. So WTF happened? The Chinese lied. Of course they did. So did the USA. But that's why we have some version of Skynet watching. And let's not forget Google, Facebook, and Apple that make the Matrix look benevolent. Whatever. Since the government will not think 2 moves ahead, we shall be forced to do it ourselves. Thus, let's consider the next black swan. The next black swan. I hope you guys are sitting down and ready for the reveal. Here we go. Buckle up, tighten up, all that good stuff. It's going to be a bumpy ride. Y'all remember that from Harry Potter? Bumpy ride. It's going to be a bumpy ride. All right. With that skeptical background in mind, Bassman looks at the opaque future in a time of corona. Corona. And contemplates how 3 key variables, the velocity of money, demographics, labor force growth, rate inflex up sometimes between 2023 and 2027 as the increase in millennials, 1980 to 1996, overtakes the decline in boomers, 1946 to 1964. Wow, so, excuse me, so boomer, man, so someone born in 1964 is now considered a boomer? That's frightening. Boomer? You're a boomer? You give a 20-year span for boomerism, but you only give a 16-year span for millennial? Why millennials from 80 to 96? And why is boomer 46 to 64? It doesn't seem so fair. It's like every 16 years or something. What's up with that? What's up with that? Okay, so, and supply chains interact and concludes that ultimately a combination of these forces will increase the demand for money. The result being higher interest rates and inflation between 2023 and 2027. Yes, but before we get there, here are the known unknowns as Bassman lays them out. First, we are fairly confident that an increase in government debt relative to GDP will hamper growth. We know that a massively expanding the money supply will alter the relationship between real assets and fiat assets, but we do not know when or by now how much. Next, we know that modern monetary theory, MMT for short, the politicians must turn off money spigot once potential is reached. We do not know if they can do it. No, they cannot. We know that residential real estate is a more secure asset than commercial real estate, and demographics favor the latter over the former. We know that gold is effectively an alternative currency, but we do not know to what degree it will be valued relative to fiat currency, or in this case, cryptocurrencies. Yeah, probably didn't think about that, did y'all? Addressing the stock market, the bond trading legend admits that he is clueless as to where the SPX, the S&P 500, will close out the year, and that I can make a compelling case for a Fed-juiced 3,400 or a COVID-related 2,350. He does, however, note that he would not short the SP 500 versus the single name assets because, as we wrote, in the entire market is now just 5 stocks. The primary reason is that the construction of this capitalization weighted index is no longer a measure of the value of the overall equity market, but rather of the top 5 stocks, who presently make up a Martin line of 21%. Good grief. It is for this reason that Bassman thinks it is unlikely the SPX can revisit the March low print of 2191, as the math is virtually impossible absent a total collapse in ad spending revenue, of course. Holding the FANG G, the FAMG. Now, hold on, I know FANG, but what's that? So Facebook, Apple, Amazon. Is that Microsoft in Google? Yeah, I think they replace Netflix with Microsoft. Okay, so FAM, folks. Instead of FANG, it's FAMG. At its current 7% decline, the other 495 constituents would need to decline by 45% to reach that level. More evidence of dispersion. Last week, the SPX was down 17%, while the median stock was 28% below its peak. Of course, the real reason for the recent market surge is the unprecedented liquidity nuclear bomb launched by the Fed, which is the 3rd time the Fed put has been exercised in the past 15 months. First, in December 2018, as the market just averted a clock-stopping 20% drawdown. Again in 2019, as the Treasury repo market jammed, which occasioned by a 60 basis point drop in the 10-year rate in a month. And finally, last month, after a global margin call prompted even the safe haven of gold to plunge by $250 or 15% in 6 days. Fed's massive injections aside, Bassman believes the V-shaped recovery is absurd and a U-shape may be wishful thinking, even as the Fed has promised to do whatever it takes. Whatever it takes. Fed's massive injections aside, Bassman believes that V-shaped recovery is absurd and the U-shape may be wishful thinking, even as the Fed has promised to do whatever it takes. But surely at some point there comes a time when not even the Fed can print its way to prosperity, or otherwise, if we have just been asking for years. And then Jeff Gundlach claimed in overnight, why pay taxes? The U.S. Treasury Department today admitted to a $3 trillion borrowing need in the next quarter. If endless borrowing is a viable solution, why did we have any taxation in the first place? As it turns out, such a point does exist, according to Bassman, who says a worst-case scenario has to include a situation where the Fed can no longer hold back the tides, and I will volunteer this occurs if interest rates significantly increase, perhaps above 4.5%, as a result of the massive debt load carried by the system. Again, massive debt load. As he further explains, the massive leverage built up in the financial markets has been supported by the correlation between stocks and bonds. See, now other people are taking note of what I've been telling you guys for years. The correlation between stocks and bonds. That is supposed, from a theoretical and academic perspective, never supposed to happen. They are never supposed to be correlated. Never, 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 ever. Since the start of the great financial crisis, known as GFC, the prices of these two asset classes have generally moved in opposite directions, offering hedge value for a diversified portfolio. That is not true. That is not true. That is not true. That is not true. They do not move in opposite directions anymore. They haven't done that since the NASDAQ bubble popped in 2000. What are you talking about? Employing a strategy of risk parity, managers might use $100 of capital to buy $70 of equities and $130 of debt instruments. As long as this correlation holds, losses on one asset will be offset by gains in the other. If this relationship flips, risk managers must reduce leverage and sell both, which is precisely what occurred in March and prompted the Fed execute an inter-meeting surprise. Yeah, you guys remember that? I've warned you that the Fed was notorious for doing, in between meeting rate cuts and rate increases. Well, that's what happened in March. Remember, it happened, and the correlations broke down again, like I told you that they happened. Bonds and equities were moving in the same direction. Then, in a fascinating observation using a chart from the Minute Advisors, Bassman shows that the correlation flips when the inflation rate is above 2.5%. He's wrong. The correlations have been doing that and breaking down since 2000. What does that mean in yield terms? As Bassman notes, the old rule is that the 10-year rate should tend toward nominal GDP. As such, a real GDP at 2% plus and inflation of 2.5% should lead to a 10-year rate of 4.5%. While a 400 basis point increase in rates presently seems unlikely, I can assure you that at the time, a 400 basis point decline from 2007's average yield of 4.60% would have been thought even more absurd. But what about the deflationary impact of demographics and debt? Here, Bassman's answer is that while demographics would keep rates under 3.5% until 2023, and MMT policies might not be fully engaged until after the election in 2028, when the entire boomer generation reaches the age of 65. Why are you scaring me like this? So the boomer generation will be 65 years old in 2028? Good grief, that's scary. Really? Really? Man. Wow. This pandemic has accelerated the clock as direct fiscal helicopter money has been added to indirect monetary expansion, QE, which brings us to the obvious conclusion, which is what, according to the bond rating guru and the Fed's biggest fear, it will come as no surprise to anyone that the answer is not deflation, but hyperinflation. Prior to the pandemic, nattering financial pundits insisted the Fed's toolbox was depleted, which technically it is. This was clearly not the case. Yes, it was. Only thing it can do is inject money, more money, more money. What was vacant was the imagination of the chattering class. For a while, the Fed may be somewhat bothered by deflation. No, they're terrified of it. Let me promise there is a Tangier folder marked secret locked in a glass box with a hammer that contains the plan for how to manage the inflation on the horizon. This is the real lights out scenario they fear. They're not just afraid of that. They're more afraid of deflation. Bassman concludes with his investing recommendations. For an investment horizon greater than 2 weeks, one should have exposure to large cap equities. They have the resources to survive the shutdown and will gain market share as the economy recovers. I take issue with that first statement. I believe that is false. I believe that the only reason why we got a technical bounce now is because the Fed promised to do more and continue to do more ad infinitum. All right, right now we don't have a market. All right, we don't have a real market. We have something else. All right, rallies only happen now because of Fed injection of liquidity into said market. If the Fed was not active in the markets in any way, shape, or form, we would have already taken out the 2020 lows. Buy quality intermediate term 4-year to 7-year fixed income assets. Sorry, sir, because of the shutdown, there is no quality. You took all that away. You took the normalcy of the ebb and flow in equity markets away when you shut down the economy. There is no safe haven anymore. How can any company make any money whatsoever if people are threatened that if they leave their house, they're going to be shot? As pandemics fear reside, no, they're not going to reside. The only reason why you have a few people walking around clueless is because they haven't watched Plandemic. The boomer demographic will reach the yield to fund retirement, and they will continue to transition out of equities and into bonds as mandatory IRA withdrawals escalate. Mandatory IRA withdrawals escalate. Own positive convexity assets with much more upside than downside. Buy 7-year into 20-year pairs, put options. Buy USD dollar yen calls, 7-year expiry. Own gold, perhaps 5% of assets. Refinance your mortgage. You own the prepayment option. Be cautious of embedded leverage. This is why M-REITs imploded. Okay, again, I take issue with his recommendations. First and foremost, he said refinance your mortgage. All right, maybe he's been living under a rock and he doesn't know this. Maybe he's also blind and he doesn't know this. Sir, valuations have been plummeting like a stone. No, I'm sorry, like a boulder being dropped off of the Empire State Building. All right. You can't get the valuations to refinance. Most people are upside down or underwater on their mortgage. And as of today, do you understand how many forbearance agreements are going out for the average U.S. household? Do you know how many people are in jeopardy? Let me tell you something. If the banks would have been kept open, I'm not the banks, I'm sorry, if the courthouses would have been kept open, but everything else shut, there would be rampant homelessness in this country. The homeless rate in this country would go up by 50% overnight because everyone would have been executed on. Everyone would have been ejected out of their properties. They would have been foreclosed on. They would have been evicted, and they would be out in the street. Let's keep it 100. They knew exactly what they were doing. They knew that as they were imploding the economy, they had to shut down the courthouses too, making it impossible for your landlord to file on you or for your bank to file foreclosure proceedings on you. All right, that's why I call it a pandemic. So no, I disagree with the refinance of the mortgage. Most people can't even pay their mortgage. They're not going to be able to refinance it. And right now, their credit is taking a beating. And then you're talking about the bonds. Are you not aware what's happening in the bond market? That's not going to help you. And you said own some gold. You just probably parroting that. Then you said 5% of assets. I don't think so. Gold should be probably 95% of your asset. What are you talking about, dude? I don't know. I think it's a dollar yen call, 7-year expiry. There must be some leaps I don't know about. I never heard of no leap with 7-year expiration. I know they got 2 years. I ain't heard no that. That's new to me. I don't really deal in options like that heavy anyway. So if that is something new to me, albeit. But do you know what premium you're gonna pay for a 7-year expiration on a dollar yen call? What? What? If you really believe that, you're better off just going ahead and just getting long the dollar yen. Straight up. Open up a forex brokerage account and just go long the dollar yen right now. That doesn't make any sense. Again, prognostication is cool and everything, but nah, gotta take issue with that one. Gotta take issue with that one. All right, so right now, man, that's all I got. I ain't got nothing else for y'all. I gotta get ready. I got some things I need to do this morning before the morning is over with. So I will see the rest of you guys in the trading room, and everyone else I'll see here at the end of day for the end of day report. And remember, bulls make money, bears make money, and pigs get slaughtered. So remember to take what you can and give nothing back. And don't forget to visit us at PulseWaveTrading.com. Peace.